Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of InkResearch.ca. He invented the Inc. Canadian Insider Index, which is used by the Horizons Canadian Insider Index ETF, a 2017 and 2018 Fund Data Fund Grade A Plus award winner. His website, CanadianInsider.com. Welcome back to the show, Ted, and happy Canada Day.
Well, Jim, happy Canada Day to you, your listeners. Happy Dominion Day. They used to be called back in the days of the old flag, the red ensign, and to all your American listeners, I know you've got quite a few of them, a happy Independence Day, 4th of July, not too far away from the Canada Day celebrations here. So,
well, so we're half the way through the year. How have we done so far, and what's your outlook for the second half?
Well, we just finished a really crazy first half of 2020, and the first quarter was the first 3 months of the year. Of course, were dominated by the implosion of markets in March, and I think we all kind of lived through that. But where do we stand now? Over the last 3 months, what's happened since since the pandemic hit here in early March? Well, where have we ended up here on June 30th? Well, on the positive side, and we would look at how our G economy scenario is faring compared to the D economy scenario. G economy being government-led inflation versus D, which would be debt-driven deflation. Now, you could say that neither of those are the greatest outcomes, but unfortunately, I don't think Goldilocks is going to be coming back anytime soon. So between the two, G is probably better than D. And as we finish the first 6 months, what do we got? Well, we've got the gold-silver ratio. It peaked in March 18th. It peaked at 125%. So gold, was worth 125% compared to silver, but it's come down. And so silver has gained ground against gold, and it's finished the first half of the year under 100%. It had a pretty good day today, blew through $18 an ounce pretty strongly. Now, silver's really volatile, so that could all change. But it was a nice showing for silver today on the last day of the quarter. So that's positive for the G economy, because you would expect silver to do well under an inflationary environment. Gold might do better under a deflationary environment. We also saw inflation expectations bottom in late March and continue higher through the last 3 months. So they bottomed at 0.5% on March 19th, a few days before the stocks bottomed, and they've been climbing ever since. So that's good news for the G economy, and it's bad news for the deflationists. I hear on our platform we have commentators from both the bearish and the bullish and the inflation and the deflation camps, and I keep hearing about how deflation is coming, but we have had deflation, but it looks like inflation won the quarter. It won the quarter. Based off of the gold-silver ratio, based off of rising inflation expectations. And I looked at I was watching the news come in today from Europe about their CPI numbers, and they all were beating expectations just for the previous month. So there's the deflationists have had a bit of a setback here, and the inflation. So inflation, I wouldn't want to say it's a slam dunk, but we do seem to have at our backs a little bit here. And why is that? Well, you'd only have to look at, what governments around the world and central banks around the world have been doing. They've been doing so much of it. And I think, Jim, we're going to look back months, if not, a year or two from now and go, of course there was going to be inflation. Look at all the trillions of dollars they were throwing at it. And, to top it all off, in terms of inflation versus deflation, on the equity side, we saw the Canadian Insider Index, looks like it's finished the quarter up 23%, and that's compared to the S&P 500, which is just under 20%. So here we've had Canadian stocks, on a local currency basis anyways, outperforming U.S. stocks, which again, you would expect in an inflationary or stagflationary or reflationary environment, however you want to characterize it. So the question will be, does this carry through to the rest of the year? The deflationists are going to say, no, the hammer's about to fall. You're going to get all these defaults and we're going to have deflation. Certainly the G economy, the inflation economy will need more fuel. You've got to have it's not going to be able to keep going on its own, but that's what inflation is all about. There still has to be, fuel will have to keep being thrown on the fire. But I don't see any inkling that the Federal Reserve is going to stop its easy money policies, and we'll have a little bit of negotiations going on in Washington. I mean, the worst case scenario would be that maybe the Democrats decide they're going to play a little dirty pool and not do a deal and hope the economy sputters going into the election. But at the end of the day, I think it's going to be hard for the Democrats to resist spending money. So I think you will get more stimulus out of Washington. So, the wind is at the back of the inflationists going into the third quarter here. We'll have to see if the gust can keep blowing strong and keep lifting inflation-sensitive assets like the Canadian Insider Index stocks higher.
We'll have more with Ted Dixon right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Ted Dixon. Ted, are people coming back to the junior markets, the junior miners and so on?
They are. And, it's been a long time coming, Jim. There was a bit of a bull market in the juniors around the QE1, QE2 days. I think it, sort of peaked out 2011, 2012, and then it's been the juniors have been in a desert ever since. But they've come roaring back. We run a morning newsletter, Inc. Research. It's available through CanadianInsider.com to our Canadian Insider Club members. And in the past 6 weeks, we've had two of our junior miners that we've highlighted have doubled. We've got a number of that are close to doubling. I mean, so things have really taken off. Valuations have really taken off. Money's coming back into the space. And I think you have to brace yourself. I mean, we could even get, if we ever got American money, like we've seen pile into some of the speculative plays down south, if they turn their attention to Canadian stocks, and there'll be some structural reasons why some of that can't happen. Some Americans just can't buy Canadian stocks, but this could be the beginning of quite a run here. Now, of course, there'll be pullbacks, and the market has a way of humbling everyone along the way. Just when you think things are rolling, it has a way to kind of bring you back down to earth. But it's been quite something. I see just in May the TSX had a massive increase in financings compared to the previous year, up 77%. And the TSX was the venture was about flat, but I think June is going to be a big month for the venture. I every night I look at we have a a little feature on Canadian Insider, Private Eye. It's a 2-day delayed. Our subscribers on Inc. Research get it 2 days earlier. But you can just see some of the deals that are getting done, and we don't put all of them on, just the ones, some of the insider ones, some of the bigger insider ones that come across our way. And it used to be in the past you could go a few days without seeing one, but no, we have multiple private placements closing every day these days. So that's really good for the juniors. They're starting to get some money in, and money's coming in, and deals are being upsized. So there's definitely money heading into the space, and it's been a long time coming, but here it is.
What should a person do? Because we know a junior can be a great way to lose money if you're not aware. Should you use ETFs, spread it out, or just do really intense research to make sure you're getting into the right venture? Or, of course, a combination of both. Right.
Well, one should always do their due diligence. And unfortunately, there are no ETFs really in the junior space. I know there's a U.S. ETF that bills itself as a junior gold thing, but no, it's not. It's what we would call a mid-tier gold producing ETF. But in Canada, juniors really mean explorers, and so no ETF. There used to be, but it was taken off the board a few years ago. And the trick here is really to do your due diligence. And how do you do that, especially if you're new to the space? Okay, well, let me tell you some of the things that we watch for at Inc. Research. We do have our screens, our Inc. Edge screens, which look at value, insider commitment, and price momentum. One of the problems with that is some of the smaller stocks, they don't qualify for our screens. So what do we do? Well, if there is a financing, what we always look for, and this is something I talked about in Inc. Chat, which is our subscriber forum on April 10th, is we can look at warrants in a deal. And a rule of thumb, the fewer the warrants, the better. In fact, I would say right now, because we're in a bull market, there really isn't a need. There shouldn't be a need for a good quality project, good quality management, to either have any warrants or have warrants more than 18 months. Okay, so if you see a company that comes along and does a deal that's warrant rich with multiple years, you got to ask yourself, why in this market are they doing that? Okay, well, that would be a red flag for me. Any kind of any private placement that's loaded up with warrants, I would be suspect right now on that. Generally, though, across a longer time frame, to find that the bigger the insider ownership in a company, the less likely they are to do a warrant-rich deal. And by warrant-rich deal, I mean having a lot of warrants with generous terms. Insiders, if they own a lot of the company, they don't want to dilute themselves. If the insiders don't own a lot of the company and they're really just there for a paycheck and getting, consulting fees through their consulting company, they really don't care. They just want to keep the money flowing in. And those are the companies you want to avoid. Yes, they may be going up now because you have money coming into the space, but if the music stops or you get, a pullback, you could be out of luck. And then when the tide comes, when the tide starts to roll again, then you wonder, well, why isn't this stock going up with the rest of the junior market? Well, because the market's probably wondering when the next financing is going to be. Those companies tend to do a lot of financings, and there's going to be another one coming around the door before you know it. So look for the amount of warrants and the amount of insider ownership. And the number one red flag that I would point to on any warrant deal is a 5-year warrant deal. Okay, I call them 5 long years of warrant expiry. And I know there are players in the industry who love those 5-year warrant deals, but they're usually on the other side. They're usually buying the deals. And so it's great, if you can negotiate. You have the power, and some market participants, who are familiar to many of your listeners, do have a lot of power in these deals, just through their broad connections and their savviness and their and their connections, which is fine. There's nothing wrong with that, and and you can't blame them for putting that to work, their experience and their expertise and what they bring to the table, which is usually money. So, but the problem is, if you're an existing shareholder and one of these deals comes along and you got 5-year warrants, it's just a signal that, the issuer probably really needed the cash, and they were able to cut a deal, which, is better than not being able to cut a deal, but the terms were probably signaling that, the deal was quite risky, and even, the sophisticated players, they were looking for, to mitigate their risk, and you can't blame them. It's quite rational from the buyer of the deal, the person cutting the check, departing with their cold hard cash. They're going to want to get the best deal possible. And if it's a really risky deal, they're going to want to mitigate that risk as much as possible. And so what do you look for? Well, if you have these 5-year warrants, especially now, and it's more, I think it's a signal. It's a very risky project. Doesn't mean it can't pay off. Doesn't mean the stock, can't do really well in a bull market. But there are plenty of fish in the sea right now, and we cover them. In Canadian Insider, we don't get paid to cover stocks. We just follow our models and our screens. Well, they're really screens, not really models. We look at the data, and that's what drives our coverage of stocks. So, just be on the lookout for that. In terms of financing, companies have to do financings. Drilling is expensive, and it's just a fact of life in the juniors. But you want to make sure the management is looking out for your interests. And one of the main ways you can get ahead of the game is seeing how many shares, what percent of the company do they own. On Inc. Research, we let you know if a company is above or below median ownership, and you can actually get a PDF. If you're not a subscriber to our premium service, which is quite expensive, you can still buy a PDF pretty cheaply off of CanadianInsider.com for a couple of bucks, or you can join the Canadian Insider Club, which is a pretty good deal in terms of getting access to a lot of that research. And just take a look and see how much ownership the insiders have. And that in this market, it's one of the key pieces of the puzzle I think you can look at, and to stay ahead of the curve, and just have some confidence that the insiders are working for you, as opposed to working as a way for them to sort of continue their lifestyle and use the mining industry as a way to enrich just themselves, as opposed to trying to make everyone better off.
We'll have more with Ted Dixon right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration, with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Ted Dixon. Ted, Alberta has drawn up a $10 billion recovery plan. Are other provinces doing the same thing, or are they dragging their feet?
Well, I'm not familiar with the plan. I did see a headline. Someone in our chat group actually pointed that out to me. I just haven't had a chance to look at the details. But look, I think in this situation with where we're at, provinces are going to be very constrained in what they can do. The government that has the best ability to make the most out of a tough situation is the federal government. So I don't know where Alberta's getting its money from to do any kind of stimulus. They're heavily indebted, and the energy industry is struggling right now. I think there are some positive indications that it's maybe hit bottom here, but it's going to be a long road back, and we can't take anything for granted. So you can as a government, you can make strategic moves but I'm always worried about governments making even strategic moves, because that often means them making decisions of who's going to win and who's going to lose. You just have to be very, very cautious. Governments have to be at the provincial level are going to have to be very cautious. They're going to have to make sure that they have public health, for example. I mean, that would, Canada finally got its act together as a country on the COVID-19. Fortunately, we did have at the provincial level the public health infrastructure in place. I mean, I still think some provinces are yet to fully get on top of things, but in general, it's coming together. And in British Columbia, the public health investments that previous governments and the current government have made, paid off. So, I would at this point like to see provincial governments stick to their knitting, public health, and not go off on adventurism to try and stimulate the economy. The federal government has a printing press, and I'm not suggesting that that's the right way to do it. All I'm saying is they have a printing press. Provincial governments do not. Provincial governments can only go into debt or raise taxes to pay for their programs. Federal government, it has a few more options. And, what those options should be is a political decision. And so I won't go down that rabbit hole today. But the federal government just has more options to help stimulate the economy. So I would look more towards what they're doing to bridge any gaps here. And so let's keep our eye on what Ottawa is doing. And and for provinces, their number one priority has to be the public health side for sure.
Ted, thank you so much for chatting with us, and have a great Canada Day.
Same to you and all your listeners.
My guest has been Ted Dixon, CEO and co-founder of IncResearch.ca, his website, CanadianInsider.com. If you have any questions for Ted or any of our other guests, you can send them to info@HowStreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.